Good day, ladies and gentlemen. Today we're going to be taking you through task C of the 2021 APC. So looking at the pre-release information on page 22, you got some information in terms of some leases, some debentures, and also some relief and taxation relating to certain transactions. So Ryan sends you an email to say, you know what, he'd like you to brush up on some of your technical knowledge. And the first thing he wants you to brush up on is the fact that some terms and conditions of some leases have been adjusted, have recently been modified. And one of these adjustments is a payment holiday that was granted by one of the lessors. Second one that we are told about is that because the company has been facing some funding difficulty during the year, they've decided to issue some debentures to some parents, and these debentures are going to be settled in annual installments by converting these debentures into tuition fees. And very importantly, they tell us then that early settlement discounts will not apply then. So that's a negative trigger for early settlement discounts in relation to the debentures. Then we are told that there's some parents that have made some requests and they've been struggling to pay some of the tuition fees, and they're looking for relief for the tuition fees because they cannot afford. And then lastly, we are told that because the company is not a registered PBO, we would also have to consider some of the tax implication in relation to these transactions. On the day of the assessment, ladies and gents, you get an email from Ryan again. And Ryan tells us that, you know what, he's attempted to document some of the main accounting implications in relation to these transactions. He knows his debits and credits, and he believes that he's been able to point us in the right direction as a starting point. And he definitely has not considered or attempted any of the tax implications. He then tells us that in the next page, he's given us context or details of some of these transactions, and has also given us what he thinks the main accounting implication should be for each of these transactions. Ryan then further on says we need to provide him constructive feedback that he can take forward in order to keep the auditors off their backs. So he's looking for constructive feedback on the accounting implications that he has documented for us in the next page. He then also tells us that we should also discuss the income tax implications relating to the debentures, and we shouldn't worry about the tax in relation to the leases, which is transaction 1, and the rebates, which is transaction 3. And lastly, and very importantly, ladies and gents, Ryan says to us that we need to keep the feedback simple. He needs to find it easy to understand because we can get quite technical with our CA jargon. Okay, so let's look at the first transaction. So in the first transaction, this has got to do with the changes to the lease. We know this was triggered. We were told that there were some modifications to some lease agreements, one of which constituted a payment holiday. So of these changes to the lease agreement, the first one we have is that there's been an extension of the lease period of one of the leases. So definitely no increase in the amount of lease payments due, but simply the entity could use the same asset just for a longer period of time. Then the second change we had, ladies and gents, is one which was the term or the condition was included in the original contract. And here they tell us that, you know what, after the recent market rental rates review, they have decided to adjust those lease payments by showing a reduction in those lease payments. And then lastly, we are told that they were granted a payment holiday, and this payment holiday essentially constituted the deferral of the lease payments of 6 months of lease payments that were originally due in 31 December 2021 to a later date. And what Ryan then says to us is that, you know what, the accounting implications for all 3 of these modifications of these lease terms are substantially the same. He wants to adjust the lease liability, and the contract to that is to adjust profit or loss. I think very importantly, ladies and gents, here, we are going to get into more detail in terms of what was required under each of these, but what's important is that he's asked us to keep it simple. He's asked us for constructive feedback. Furthermore, Ryan gives us information about the debentures that were issued to the customers. Once again, this was triggered in the pre-release period. And here we are given a little bit more detail that, you know, there are 8% debentures that were issued, and we are told that they will use these debentures to settle the tuition fees. Also, very importantly, they give us that the term of the debentures is now 5 years and it will be settled in equal annual proportions. Should a learner leave the school, then the school will have to then pay or settle those debentures to the parents, and those will be settled in cash. So Ryan gives us his main accounting implications, where he wants to recognize the debentures at the cash amount received. So on day one, wants to recognize it at the cash amount received. He wants to recognize interest. And also importantly, every year, he wants to recognize revenue at the beginning of each school year. Remember, keep in mind all the time, we're looking for constructive feedback. We are looking at the same time to try keep it as simple as possible so that it is easy for Ryan to understand. Then we've got the rebates. So in the pre-release, it was triggered that some parents have come forward to ask for some relief on tuition as they simply could not afford the tuition fees. So here we've been told that, you know what, the board has approved a rebate for financially deserving households, and the rebates are not the same as an early settlement discount that is granted to parents. They rather represent a reduction in the tuition fees, for the households that can't afford the tuition fees. But what Ryan has then done is that in his main accounting implications he's given us, he wants to recognize a rebate expense to reflect that reduction in the fees that they're not going to get. So he wants to recognize an expense and wants to then reduce debtors as these parents will no longer be paying this amount of tuition. So, ladies and gents, having looked at the information on the day and the pre-release information, but specifically the information on the day, there are four themes rather that we have to consider. The first theme we have is the leases, right? Definitely we have to cover leases in our response. The second theme we have are the debentures. We have to cover debentures in our response. The third theme are the rebates for that relief on tuition. So we definitely have to have that in our response as well. And then lastly, it's the taxation, but only on the debentures. That's what we then need to consider. These are the four themes we need to consider in responding to this task. So the first theme I'm going to talk about is the one of leasing. And if you really look at those three lease adjustments or modification to the terms, the first lease that is provided to us, we are told that it's an extension of the lease term. We are still paying the same amount of lease payments. Ladies and gents, it was not clear in this scenario whether this term or condition was included in the original contract or not. And for this reason, if it was included in the original contract, I think we all can appreciate that then this would not be a modification, but rather a reassessment of the lease liability. But if it wasn't included in the original lease contract, then this would then be treated as a modification. So definitely for that first lease, we've got the issue that, this could be a reassessment, this could be a modification. Importantly, I need to understand why you are saying it's a modification or why you are saying it's a reassessment. The second lease we have there, we are told that we have a reduction in the lease payments in response to the market rental review that has recently been done. And this condition was included in the original lease contract. So definitely here, ladies and gents, because it was in the original lease contract, this is not a modification. This is definitely, without question, a reassessment of that lease liability. And then lastly, we've got that last modification to the terms and conditions, which they tell us it was a payment holiday. The payments are due before 31 December 2021. And there, ladies and gents, we would have to explore the applicability of that practical expedient. So, and obviously we're looking for discussion in terms of, okay, are we applying the practical expedient or not, and why? So definitely, ladies and gents, in terms of under the leasing theme, the things that we'd have to discuss or identify and discuss firstly is the type of how do we treat this modification to the terms. Is it a modification of the lease? Is it a reassessment of the lease liability? Is it the practical expedient that is then applicable? Okay, so what else do we need to discuss under the leases theme? The next thing we'd have to discuss under the leases theme are the discount rates, because the discount rates are actually quite key in terms of knowing how to account for this adjustment or this modification of the terms. And we know that for the first one, that extension of the lease term, with the same lease payments. That we said is either a modification or reassessment, depending on how you argue it. If it was sitting in the original lease contract, then definitely it's a reassessment. If it was not in the original lease contract, then we're sitting in a modification. Regardless of how you want to treat this, either a modification or reassessment, the discount rate that we are going to use to remeasure that lease liability is going to be the revised discount rate. It's going to be a discount rate at the date when that change occurs. Okay, so that's an aspect we need to discuss in terms of the first lease adjustment or the first lease modification of terms. The second one we have there, that reassessment, where it's in response to the market rental review assessment. There, ladies and gents, it's quite clear it's a reassessment. And because it's a reassessment, the discount rate we are supposed to utilize there is the original discount rate that was determined at the commencement of the lease. Remember, we are giving Ryan the main accounting implications. How do we measure this thing and how do we record it? So the discount rates are a key aspect in these main accounting implications. The third modification to the terms, we are told that this was a payment holiday that was granted by one of the lessors. And we know that because these payments are due before 31 December 2021, as well, the lease payments are substantially the same as what they were before this payment holiday was granted, and there are no further changes to this lease agreement or other terms of this lease. Definitely, we can apply the practical expedient. And once we can apply the practical expedient, ladies and gents, we are told in that practical expedient that we have to use the original discount rate, the discount rate that was determined at the commencement date of that lease. Then lastly, ladies and gents, is it would be important for you in your discussion to tell Ryan what adjustments need to be made, because remember, he wants to adjust the lease liability and he wants to take that adjustment to profit or loss. So definitely that is not true for all of those modifications to the lease term. So the first one, where we had the extension of the lease term, because it is a modification / or you could argue a reassessment, IFRS 16 specifically tells us that that adjustment needs to go to the right of use asset. So definitely not profit or loss. But if the right of use asset is going to end up being a negative balance, then the excess will have to be recognized in profit or loss. So that is the adjustment we want to explain to Ryan for that first lease modification of terms. The second lease modification of terms is similar to that first one, where we say, you know what, yes, this is the lease reassessment. We have to remeasure the liability. We have to use the original discount rate, but that adjustment needs to go against the right of use asset. It does not go through profit or loss. Obviously, if the right of use asset is going to then be negative as a result of this adjustment, the excess will have to be recognized in profit or loss. And then lastly, ladies and gents, in terms of those adjustments in relation to that practical expedient, we know that Ryan was actually quite correct that you can adjust profit or loss with with that change or that modification of that term. So for that one, he was correct, and he got the main accounting implications correctly. So what I'm going to do now is hand over to the next team leader, who is going to take us through the debentures theme. Thank you very much.
Thank you. And ladies and gentlemen, I'll be taking you through the second and third theme, the debentures and the rebates on task C. So firstly, let's talk about the debentures. There were two sub-themes there that you need to address as part of the expectation of Ryan. And remember, keeping it simple and providing constructive feedback on what he has done on the information today. So firstly, we need to go and interrogate the actual debenture instrument. And with that, we needed to go and talk about the classification, the initial and subsequent measurement on the debentures. Okay, and again, we were not looking for all three components to be there, because information today could have led to you to only focus on interest, or only focus on the classification, or only focus on the initial measurement, and not all three of them necessarily. So we were looking, and Ryan is looking there for constructive feedback of what is done wrong, possibly, and you providing information on that would have shown a reasonable expectation of that you understand the accounting implications on the debentures. So firstly, the classification. There we were looking for either classification in terms of IFRS 9, where we went the contractual obligation route, or going IFRS 15, where you say there is no contractual obligation because of the settlement and tuition fees, and therefore it's a contract liability. Okay, so both approaches were appropriate on the day. Then the initial measurement. So if you went the IFRS 9 route, obviously it needs to be measured at fair value. And again, it's important to differentiate between cash and fair value for Ryan, because he measured it at cash. And there is a chance that, you know, the interest rate of 7.25% is the market-related interest rate, and it would mean that the cash could be the same as the fair value. But a very good candidate would have gone in there and said, like, okay, the 7.25% is not necessarily market related, and therefore there is a chance that the cash is not the fair value, and would have gone there to talk further about the day one gain and loss, etc. Okay, but that we'll talk about when we look at the HC script. And then obviously after the initial recognition and measurement, we need to go and discuss the subsequent measurement, which is quite simple in terms of IFRS 9, which will be your amortized cost using the effective interest rate method. Okay. And if you went on the IFRS 15 route, again, just talking about the interest being accrued onto that liability and capitalized on that liability would have been appropriate. Okay. So that's the basics on the debentures. Then if we've gone over to the revenue, which is actually the crux of the debentures theme, is to firstly identify that what Ryan has done is actually incorrect, where he recognized revenue upfront at the start of the year by reducing the liability and recognizing revenue. And, taking it a step further, and a second step of this specific revenue issue is to actually go and explain to Ryan that actually the recognition of revenue should be based on the concept of control and should be recognized over time and not at a point in time upfront at the start of the year, because then you'll be recognizing it prematurely. Right. And that was very important to actually have both elements there for the revenue, not only saying that there's an issue, but also explaining what is the issue and how do you correct it. And that was quite important. Then in terms of the rebates, moving on to the third theme, there was quite simple. So what Ryan has done on the day was recognizing expense against debtors. But if you look at the principles in IFRS 15, if you've done your work in the pre-release, you would have realized that, something like a reduction of revenue and tuition would be regarded as a reduction in revenue or variable consideration rather than an expense. All right. So that was the crux there, to talk about reduction of revenue. And yes, there could be more elements to consider, such as variable consideration, how it would be estimated. A very insightful comment would have been to say, like, you're actually modifying the original contract, and therefore it would be a modification in terms of IFRS 15, and gone into the detail of that. And also picking up that, the estimation of the variable consideration could be a significant judgment and estimation uncertainty that needs to be disclosed. So those are some of the more HG indicators that you could have brought in there. All right. But I want to hand over to our next team leader or task leader to take us through the taxation. Thank you.
The final theme that candidates needed to consider as part of Ryan's request was the tax consequences relating to the debentures. In answering this theme, candidates could have considered, as it related to the 8% interest payable on the debentures, whether that interest would be allowed as a deduction in terms of Section 24 Cap J, or as it relates to the debentures, which were prepayment of school fees and would be revenue in nature, when that amount would be included into gross income. Having looked then at what was expected in this particular task as it relates to the four themes being leases, debentures, the rebates, and the taxes, In the next part of the video, we will have a look at a selection of candidate scripts that demonstrated the required level of competence in this particular task. In the next video, we will have a look at a highly competent candidate script, a competent candidate script, and then also look at a limited competent candidate script, and focusing on how those candidates dealt with the various themes as well as the expectations in terms of each of those themes. In this video, we will now have a look at a competent candidate's solution in task C. The candidate starts off with the salutations and then says to Ryan that attach, he should find their constructive feedback on his working. The candidate then deals with each of the three matters, being the leases, the debentures, as well as the rebates separately. So let's now first have a look at matter one, which is the leases. The candidate first starts off with a general introduction to his discussion or her discussion, and says that they do not fully agree that the changes reflected in the leases are substantially the same. And that's sort of a rebuttal then of Ryan's viewpoint then that each of the leases are the same and would be accounted for in terms of in profit and loss. The candidate then provides sort of an introduction as to how they've gone about approaching in answering this particular task or part, and says that they've split each of these below and provided further commentary. And so quite well, the candidate has then provided a table with the three leases, lease one, which dealt with the extended lease period, lease two, which was a reduction in lease payments, and then the third lease agreement, which had a potential rental concession, and then provides commentary to the right of that particular column. So let's go and have a look at the candidate's commentary then on lease one. So the candidate, again, general introduction says, asks a question as to whether the extension periods were part of the original contract or whether they were subsequently added to the particular contract. Now, the scenario on the day was not clear as to whether this extension was part of the original contract or was subsequently added. Quite well, this particular candidate goes on to then deal with both and says, well, if it was not part of the original terms and conditions, so let's just highlight that there, then that would be a modification. So one of the themes that a candidate needs to deal with is leases, and under the leases theme, candidates needed to identify, well, are there modifications, reassessments, or practical experience? Correctly here, this candidate picks up that in terms of lease one, well, if it was not part of the original terms and conditions, it would be considered a modification. But the candidate then articulates themselves further very well and says that if it was part of the original contract, then it would not be a modification, but would rather be considered a reassessment. So it deals with both elements there. The candidate then continues and says, well, that the remeasurement would have to be at the revised discount rate. And so therefore is picking up the elements or the transaction theme there relating to the discount rate that would have to be at the revised discount rate, and then also rebuts Ryan's viewpoint then that the adjustment would have to go against profit and loss and says, well, no, the adjustment would activate the right of use of asset account as well as the lease liability. So therefore picks up the adjustment. So if you recall, under our leases themes, we need to deal with modifications, we need to deal with the discount rates as well as the adjustments. In this particular case, as it relates to lease one, candidate picks up on all three of those elements. The next lease, which is reduction in lease payments, the candidate now concludes appropriately and says that this would not meet the definition of a modification. And that's based on what Ryan had said in terms of the information on the day. It was part of the regional contract. So if we read it in context as to what the candidate just said, sort of in terms of lease one, that if it was part of the original contract, it would be a reassessment. So therefore, the benefit is given to the candidate here that says, well, it's not a modification, it would then be a reassessment. The candidate then says, concludes, it's a reassessment, that this will be remeasured using a revised discount rate. Now, the candidate picks up, well, this remeasurement would have to be based on a discount rate, but incorrectly uses the revised discount rate. So it doesn't get the benefit in terms of the discount rate relating to lease 2, because that is incorrect. Ultimately, this particular task was a technically driven task, and so therefore candidates had to demonstrate not only their professional competence, but also the technical competence of providing Ryan with the correct answers. So doesn't get the benefit then for the revised discount rate, because that is incorrect. Candidate, however, then continues in terms of the adjustment and picks up correctly that the adjustment would go against the right of use asset account and then the lease liability. And correctly also provides us with the journal entries here and says, well, that the right of use asset account would be credited and the debit would go against the lease liability. So under lease 2 picks up on 2 of the areas that needed to be dealt with, picked up on the reassessment issue as well as the adjustment issue. Finally, then, in terms of the third lease, the candidate provides background information on the practical expedient, and then concretely concludes that because this is a 6 months rental concession, that it is on or before the 30th of June 2022, that the practical expedient would apply in this instance. So in this instance, the candidate, or this particular candidate, has picked up on the modification issues, the reassessment issues, as well as the practical expedient issues. So ticks that first box under leases. The candidate then continues and says, well, the current accounting treatment indicated by you is appropriate. That is the adjustment. The practical expedient does provide that the adjustment, okay, would go against profit and loss as well as the lease liability. So Ryan's explanation would be correct in this regard. So because he is correctly concluded and said to Ryan, you've done what you've done is correct, here the candidate has given the benefit for the adjustment. Finally, then also the candidate says that, well, your basis of going to P&L is on the assumption that the unchanged discount rate was used. Correct again is as it relates to the practical expedient and the accounting treatment thereof is that the unchanged discount rate would have to be used in this instance. So in terms of lease 3, the candidate has picked up on all 3 areas: the practical expedient, the discount rate, as well as the adjustment. The candidate then continues and deals with matter 2 in this instance. So what has the candidate dealt with in terms of matter 2? This competent candidate has started, correctly identifies that in terms of the debentures, that the debentures would be classified as a financial liability in terms of IFRS 9. Doesn't just conclude that it's going to be a financial liability in terms of IFRS 9, but also provides a reason why they're concluding. Correctly then concludes, well, it's going to be dealt with in terms of IFRS 9 because the company has a contractual obligation to deliver the cash should the child leave the school for whatever reason. So in this instance, the candidate is picking up on the classification issue of the debentures here. And remember, the classification needs a reason why. The candidate deals with the initial classification, then continues and deals with the initial measurement. And if you would recall that Ryan was of the viewpoint that the debentures would be recognized merely just at the cash amount received in terms of the debentures. Candidate correctly deals with the initial measurement here and says, no, that these debentures should initially be measured at the fair value of the debentures on day 1. The candidate also then lightly considers, well, linked to this fair value issue is that there is also a possibility that if there are transaction costs attached to the debentures, that there might be a day 1 gain or loss relating to these debentures. So furthermore, the candidate then continues in terms of the debentures theme to pick up the next area and says that as it relates to the debentures, there is this 8% interest that is payable, and this 8% interest would be recognized as an expense. So in terms of the debenture themes, the candidate has picked up on all three areas that needed to be dealt with here. There's the initial classification, picks up on the initial measurement, as well as the interest. And you would recall that it was only expected to deal with one of this, but quite a good, comprehensive consideration of the various areas as it relates to the debentures. Finally, then, the candidate correctly picks up on a fundamental error or issue which Ryan presented to you in the information on the day. You'd recall, as my fellow task leader had said, is that in the journal entry that Ryan had provided you with, Ryan recognized the full revenue at the start of the school year by debiting the debentures and crediting revenue. This candidate correctly picks up that revenue should only be recognized once the performance obligations have been met. And instead, at the start of the school year, Ryan should have created a contract, a liability should have been recognized, and then that on a monthly basis, as the performance obligation has been met, the contractual liability should be decreased and revenue recognized. So picks up then on that revenue area there, that the revenue must be recognized over time and not at a point in time. Then the second component of the debentures, you would recall, is that Ryan had asked you to deal with the tax consequences of the debentures. So our fourth theme. In this instance, the candidate deals with both elements or both tax elements. As it relates to the tuition income upfront, picks up here that the income received will constitute or be revenue in nature, and then now starts to unpack the gross income definition here and provides us with a rationale that, well, the amounts would only be included into gross income once the company becomes unconditionally entitled to the amount. The candidate therefore then goes on and to say, but wait a minute, this is a prepayment ultimately of school fees, and this is closely linked to the income earning activities of the company. And this is going to, the company is going to generate revenue from this tuition fees. And then concludes, well, as it relates to the debentures amount, there is the sort of grayness between whether the amounts are received or whether the amounts are accrued to the taxpayer, and concludes here that the total annual fees should be converted into gross income. So the entire amount should be included into gross income in this instance, so all 5 years. The candidate then goes on to introduce the principles of Section 24 Cap C and says as well, because there's been this upfront incurral or inclusion of the school fees into gross income, that the company could claim a Section 24 Cap C allowance. Remember, in the APC, there's always a tolerance for errors, and the application of Section 24 Cap C in this instance does not apply here, because the prepayment that's been received, there's no contractual obligation in this instance, and so therefore Section 24 Cap C cannot apply. However, the benefit has been given to the candidate in terms of the gross income inclusion as it relates to the debentures. The candidate also then deals with the interest and correctly picks up that, well, the entity here would be entitled to a Section 24 Cap J deduction as it relates to the interest. So in terms of tax, picks up on both areas under the tax theme. Finally, then, the candidate then deals with the rebates and concludes that in substance, the rebate transaction is a discount transaction, and therefore the amount that should be recognized in revenue should be net of the rebate. And so there should be no rebate expense, but rather is that whatever we've accounted for in revenue should be less based on the rebate that has been granted in this instance. So, having worked through the competent candidate script, let's just revisit the various themes which this candidate has dealt with. The candidate has dealt with all four themes, being the leases, the debentures, the rebates, as well as taxes. Under the leases, the candidate has correctly dealt with the modifications, reassessments, as well as practical expedient. The candidate has identified discount rates, has gotten one discount rate incorrect, but has at least two discount rates, which is sufficient. The candidate has also picked up on the adjustments relating to lease 1, 2, as well as 3. So in this instance, the candidate has gotten all three areas or dealt with all three areas. In terms of the debentures, the candidate has dealt with the classification, the initial measurement, as well as the interest. Not expected to deal with all three of those, but a competent candidate that has dealt with all three areas and so demonstrated, depth in the solution. The candidate also correctly picked up that revenue is recognized as the performance obligations are satisfied. In terms of the rebates, the candidate correctly dealt with or concluded that the rebates should not be a rebate expense, but should be a reduction in revenue. And then in terms of the tax theme, the candidate picks up that the Section 24 Cap J interest deduction should be applicable, also picks up the gross income, incorrectly concludes there on Section 24 Cap C, but because the candidate said is the full 5 years worth of debentures amounts will be included into gross income, there's this tolerance for errors as it relates to the application of Section 24 Cap C. Clearly a candidate that has shown both depth and breadth in the solution.
Okay, so we'll be looking at our HC script. I just want to remind you just to refer back to the diagram that we've used earlier in this video or recording, just to sense check what we speak about in terms of the debrief on this particular script. Okay, right. So I'm going to jump right into it. So in terms of the leases, if you go to lease 1, the candidate just goes into the detail of COVID-19 and the practical expedient, then picks up on the modification on the first lease, saying that because of the fact that there wasn't clauses in the original terms of the agreement, this would be regarded as a modification and not a reassessment. Okay. Also, the candidate went into, in the next paragraph, went into the detail of, whether or not we should separate it from the original lease and have a separate lease recognized on this modification, and concluded that it should not be, okay, which is correct. Then the candidate goes into the detail of the remeasurement. It talks about that the incremental borrowing rate should be revised, which is correct. And then also goes into the detail of calculating it, which wasn't necessary, maybe a bit of overload, but it was okay. Then it goes into the detail of the actual adjustment, making the adjustment to the liability and a corresponding adjustment to the right of use asset, all right, and picking up that Ryan made a mistake on that. All right, so that's for the first lease. So basically picking up on the modification, picking up on the rate that has been used, and also the correct adjustment. So full house there. Then for the second lease, again, picking up that the practical experience should not apply, and then going into the detail of saying that the original lease agreement had this clause in there, and therefore it's not a modification, but rather a reassessment. Okay, so again, picking up on why, all right, giving an explanation on why. Good. Then also picking up on the adjustment. So again, saying that there should be adjustment to the liability, but also to the right of use asset. Right. Unfortunately, this candidate did not pick up on the discount rate, but at the end of the day, this did not influence his competence. Then the third lease, picking up there on the COVID-19, that the practical experience could apply because it relates directly to COVID-19 implications. Okay, and then goes into the detail here on the actual requirements to apply the practical experience. So this candidate actually went into the detail here, applied it to the company, to Archegos, and therefore concluded that the practical experience should apply, which is correct. Okay, and then it goes there into detail and say here we would need to reassess the lease liability based on the new expected cash flows using the unchanged discount rate, which is correct. Okay, then also picking up that the lease liability will then increase or decrease based on the results, but in this case it should actually increase, and then saying that there should be a corresponding adjustment to the liability, obviously, then, and also to the profit and loss. Okay, so if you look at the leases, actually very, very good response, covering basically everything except for missing out on the one discount rate on lease 2. Then if you go to matter 2, the debentures, the candidate says it should be a financial liability under IFRS 9 and say because there's a contractual obligation to settle, all right, which is correct. And then also goes into the detail of saying that it should be at fair value and not the cash amount. Then the candidate goes here and explains that there could be a day one gain and loss, all right, because the cash amount would be different to the fair value in the case where the rate of 725 is different to the market-related interest rate. So this is quite insightful, picking up that the day one gain and loss could be recognized, and questioning that 7.25 that is not the market-related rate and therefore influencing the fair value. Okay, so this is a HC indicator. And very important, it is applied. So it's not only just saying that, there could be a day one gain and loss because of IFRS 9. Actually goes and applies the rate of 7.25 and say it could be different to the market-related interest rate, and they need to go and determine it. Okay. Then it goes into the detail here on the actual amortization, how it gets calculated, etc. Not really too meaningful, so therefore we skip that part. And then goes into the detail of or the subsequent measurement of explaining that it's amortized cost and that the interest gets accrued every year and that they don't fair value the debentures. Okay, good. So that's a reasonable coverage of the debenture and the measurement of the debenture. Then if we go to the revenue part, so the candidate here explains the concept of control in terms of IFRS 15, and then not using the IFRS 15 terminology, but explaining that the education services will be recognized on a monthly basis and should not be recognized at the beginning of the year. All right, so picking up on the IFRS 15 principle, and also that it should not be recognized at the start of the year. So picking up on the issue that Ryan recognized revenue prematurely. Then goes further and explains that at the beginning of the year, the debentures rightly decreased. Okay, so it should decrease. However, the rate of entry should firstly go to deferred revenue. So basically explaining that it should be deferred revenue and income received in advance and not revenue. Okay, and then also explains the subsequent journal to say that thereafter we will recognize revenue on a monthly basis by debiting our deferred revenue and creating revenue. Okay, so again, basically a full house on the debentures here, and also picking up on an HE indicator on the day one gain and loss in terms of the market-related interest rate. Cool. Then we move over to the third matter, which is the rebates. Okay, so here the rebates, the candidate goes a bit of a longer route in explaining what the real issue is here, but in doing that, he actually or she meets a lot of or gets a lot of insightful commentary and indication of high level indicators that would lead to HC. Okay, so firstly, picking up on the principle that you can only recognize revenue to the extent of what you expect to be entitled to. Then talking about the rebates and that they are only entitled to the tuition fee amount less the rebate. So explaining that principle. So we are only entitled to what is available to us after the rebate, and therefore also explaining subsequently to that, that because we don't know how many will be approved and when it will be approved, it will be deemed as variable consideration and need to be estimated as part of the transaction price. Cool. Then it goes, the candidate goes into the detail of explaining the different ways of estimation, okay, which is nice. And then very nice here, he picks up, or she picks up, that the candidate can also be, this would also be a key judgment in terms of IFRS 15 that needs to be disclosed. Right, so that is true and something that is actually very insightful and deemed as constructive feedback. All right, so that was a nice element to this response. And then also coming now and summarizing the issue, basically saying that this would mean that we should not recognize it as an expense, okay, but rather recognize it as a reduction in revenue. Okay, good. So basically on the third matter, again, picking up on the issue and also going into more detail and a couple of insightful commentary that has been added to the rebates. Then if you go to the taxation, the final element. So for the taxation, clearly here the candidate picks up on the section 24J interest that can be deducted, okay, and therefore we rewarded the candidate with that expectation or level of competence on that expectation, and then he goes further and explains what will happen on a debenture. And then lastly, also talking about the cash received on the issuance of the debenture that will be included in gross income because it is received. Right, a bit light there, but we gave the benefit of the doubt. So all in all, if you look at this particular candidate, the candidate addressed all the elements, all the themes, missed out maybe one on the discount rate on lease 2, but also added some insightful commentary on the debentures as well as the rebates, and therefore we regarded this as an HC candidate, all right, on this particular task. Right, I want to say thank you, and I'm going to hand over to our next team leader or task leader to take us through the next script. Thank you.
We are now going to be going through our third and final script for task C. So let's just read what the candidate says. So the candidate says, I hope this email finds you well. Thank you for the opportunity to review the document. Leases and financial instruments are my favorite topics. From an accounting perspective, all three types of changes are actually not substantially the same. Please see detail below. You are correct in saying that they all result in an adjustment to the lease liability, and it will be remeasured to reflect the lease payments over the remaining lease term. So nothing there at the moment. Then the candidate says the change in the first agreement is a change in the lease period. This change does not appear to have been part of the original lease agreement. Therefore, this is a new change to the contract and will be classified as a modification. So at this point, ladies and gents, we are quite happy to say the candidate has correctly identified the modification and has given us a reason why that is a modification. Then they say the change in the liability will entail a modification, gain or loss, which will be recognized in profit or loss. And I think that is incorrect. The modification adjustments will then go to the right of use asset. And if there is that adjustment is going to result in a negative right of use of asset, then do we go and adjust profit or loss? Then it says for the second agreement, the change in the second agreement is the reduction in the lease payments, and there was such a provision in the original contract for this. Therefore, this change is a reassessment. So once again, ladies and gents, here the candidate correctly identifies the reassessment and correctly gives us the reason why they consider this to be a reassessment. Third agreement, the payment holiday in the third agreement is a fairly new amendment to the IFRS. If the below are met, then we can account for it as per the expedient. The payment is as a result of the COVID-19 pandemic. The change in the lease payments results in a revised consideration for the lease that is substantially the same or less than the consideration for the lease immediately preceding the change. Then they apply to say the consideration will be revised due to the deferral of 6 months. Any reduction in the lease payments affects only payments due on or before 30 June 2022. This is made as the deferral was originally due 31 December 2021. There are no substantive changes to other terms and conditions of the lease. This is made as the only change is the deferral. There will be changes to the finance charges. However, this is not considered to be substantial. As per above, all conditions are met, and thus we will account for these changes as per the expedient. The adjustment to the lease liability will result in a debit to the lease liability and a credit to profit or loss. Therefore, you are correct. So ladies and gents, I think we are quite happy here as well that the candidate has correctly identified that the expedient is applicable and has given us a level of application of the expedient. And lastly, they go on and give us the appropriate adjustment. So just going back to this table that we spoke about earlier for the leases, we said under the leases theme, there are 3 things that a candidate can talk to. It's a modification, reassessment, practical expedient, each lease 1, lease 2, lease 3. Then we've got the discount rates. Discount rates apply to all 3 leases and various discount rates are used at the different instances. And also we've got those adjustments. This is for a candidate to tell us where that adjustment goes, because remember, Ryan has said it must all go to the liability and profit or loss. So, and obviously it's incorrect for some of those leases. So we want to see the adjustments. So for this candidate, ladies and gents, I think you'll appreciate that the candidate does the first block really well by telling us the mod, the reassessment, and also the practical expedient. But I think it's more or less about it that the candidate has gotten under the leasing theme, because they totally ignore discount rates. There's nothing on discount rates in the discussion. And then of the possible 3 adjustments, the candidate has only covered 1 adjustment correctly. So that is insufficient to say the candidate has met, the sub-theme called adjustments under the leasing theme. So under the leasing theme, we can say the candidate has adequately discussed and applied themselves to the type of modification of lease terms, i.e. mod, reassessment, or practical expedient. So let's go on to the next one. Then they say your first 2 points are spot on. However, the treatment of the settlement of the debentures is not totally correct. You correctly indicated that we will debit the debenture liability. However, we cannot credit revenue just yet because revenue has not yet been earned. Revenue can only be earned when we perform the service, providing the class to the students. Therefore, we will have to credit income received in advance or contract liability for the full amount, since no discount will be awarded. In future, as and when the revenue is earned, I think they mean, as and revenue is incurred, I think they mean earned, we will then debit the contract liability and credit revenue. We are quite happy that the candidate has adequately identified the premature recognition of revenue, but I think the candidate could have been a little bit more specific in terms of how do we recognize this revenue, because they're saying that it can only be earned when we perform the service. So do we recognize this revenue at the end of the year? Do we recognize it monthly? Do we recognize it at the start of the term? So the candidate is not quite specific, but we will give them benefit for identifying the premature recognition of revenue issue, even though the actual main accounting treatment is not quite clear. But they have indicated to us that, is as we perform, when we perform the service. Then the candidate says the tax implications of the above will be allowed a 24-day deduction for the interest paid on the debenture. We are quite happy with this, and that's correct. It's succinct, it's to the point, and it is appropriate for this question. Then they say we will be able to claim a 24C deduction in respect to the income received in advance. I can sit with you later and explain this in more detail. Ladies and gents, the 24C deduction in this case would not be applicable because remember, we need to have contractual expenditure. And also importantly, you can't have a 24C deduction if you didn't have a gross income inclusion. So the candidate has missed a step here, and definitely this would not be appropriate for this type of transaction. Then the candidate says the account of the rebates is incorrect. This may have been correct if the rebates were granted in arrears. However, since it's granted in advance, the invoices should be raised net of the rebate. The details of the full amount and the rebate can be disclosed on the invoices itself. However, the amount posted to revenue should be net of the discount. Therefore, there would not be a need to adjust the debtor's balance. Please feel free to contact me should you have any queries or you are in need of clarification on the above matter. So over here, I think the candidate does hit that the rebate issue, that it is a reduction in revenue. But the concern is with this response is that the candidate says if it was in arrears, it would be correct to recognize a rebate expense. And that is not correct. Even if it was in arrears, this would be an indication that possibly the contract has been modified. If the contract is modified, we have to go back and reassess the revenue that we've recognized. So it would still not be a rebate expense. It would still be a reduction in revenue. And for that reason, for this contradiction that has been provided by the candidate in this part of the response, no benefit was awarded to this candidate for the rebate. So really what the candidate has managed to address, if we look at our expectations that the candidate could address, the candidate has adequately addressed the modification and reassessment. Yes, we can say they've got the revenue and they've got the 24J. However, ladies and gents, this is insufficient to say the candidate has managed to display competence in their response. And as such, this candidate was graded as a limited competent candidate. So with that said, I hope the feedback has been insightful and very helpful to help you reflect on your script and in your attempt. We thank you very much.